All right, we've got about 30 seconds until we're going to get things started on a special morning edition stock market stream. So for those of you who are up early on a Sunday joining us, thank you for tagging along, and we are going to get things rolling in just a few seconds here. And that is the timer. Let me X out of this. Let's go to camera one. Boom, it worked. Welcome back to another weekly stock market stream. We are streaming live on a Sunday morning as opposed to our typical Sunday night. Honestly, reason being is because the 49ers are playing the Chargers on Sunday Night Football tonight, and that was something that I wanted to watch. So I figured we'll get it out of the way this morning. I just didn't want to skip another week of streaming. So these are all saved down to Twitch and YouTube after we're done. And if you guys want to watch those there, watch the replay. Obviously not as interactive because I can't look at the chat while you're watching after the fact, of course, but hopefully we'll have the same content. We just wrapped up a pretty successful week from a money-making perspective. We took home about $3,500 of profit. So we're going to talk about how we did that, and then most importantly, we've got a couple new strategies that we want to talk about that we hatched up over the past week. So we're going to discuss a little bit about what those are and how they work. And then finally, we're going to discuss a little bit about what we've got coming for the upcoming week. And I know we've said this pretty much every week at this point, but this is the lightest week we've had from a portfolio perspective going forward. We'll talk about why that is, and we'll talk about where we want to spend our money. And if that doesn't fill an hour or so, we can also do a little bit live stock market research, talk a little bit about the earnings that are coming up, go into their financial statements, and go through the exercise of doing a valuation of a company and figuring out, what looks good, what doesn't look good as we head into the upcoming week. So let's go back to the screen share. Normal camera, put myself in the bottom corner there. There we are, and let's jump into it. So this past week was a good one for us. Objectively, right? We made $3,460. We took home a return of 2.04%. And honestly, our goal every single week is a 1% return. At minimum. Why is that? Because if you annualize a 1% return over a 1 week period, you can go to our website if you ever need the reminder. Head over to our annualization calculator. If you started today, you put in next week as the expiry, that's a 1% return per week. That gets you 68.01% per year. Now, for those of you who follow us, those of you who watch the streams a lot, you know that a 1% return a week is very, very good. But for those of you who may not, who may come from an option buying background or other type of trading background, where you see people go for 20, 30, 40, 50, 100+% returns, which are very unrealistic. You might say, okay, 1% a week, that's not very good. But if you had like a $25,000 account and you got 1% a week, within 5 years, you'd have over $250,000. If you started with a $100,000 account, within 5 years, you'd be over $1 million with just 1% a week. And we love to talk about exponential returns and compounding returns because if you up that to 2%, and let's just say you have $10,000 in your account and you make 2% a week, within 5 years, you go from having a return of 100. You go from having an account balance of $133,000 to having an account balance of 1.7 million. So getting that 1% or more per week is exactly what we go for. We do want to temper expectations because we know historically that the S&P 500 only returns 9 to 10% per year. So we're not going to sit here and act like we're going to get 1% per week and going to get 68% per year. There's some weeks or some years we may do better. Like last year, we took home 110%. This year, we're down 3%, I think, but that's in the face of a pretty big market dip. But again, it all kind of balances out. That's just what we like to target as a base goal per week. So objectively, we accomplished our goal in the sense that we took home 2.04%, which is twice that. The big issue here, though, and this is kind of one of the risks, quote unquote, with our strategy, is that the market had a historic week running up 5.89%. So we underperformed by 3.85%, which is a pretty big ding from a over underperformance perspective. Objectively, if you told me we were going to underperform by 3.85%, I would not have been happy. But we always want to take a step back, look at things in context, and assess the bigger picture of the market. Yes, we underperformed by 3.85% this year, but this is our overall performance against the S&P 500 and NASDAQ. We are the blue line, and despite basically shooting ourselves in the foot in January with some mistakes that we've since cleaned up, we're still outperforming very, very nicely. In fact, if you go out here, I've calculated it. We're outperforming the S&P 500 by 12.85%. And we're outperforming NASDAQ by 25.24%, which is pretty massive for a 1 year basis. And of course, if we go back to when we started publicly tracking our trades in July of 2020, we're absolutely crushing both of these indices with a triple digit lead on both of them. So while in the short term, yes, the market may run up a bunch, we may not capture the full extent of that run. The great part about our strategy is, for the most part, when the market takes these dives, we're not going to be hit as hard. It results in nice, steady profit generation. And one of those things where if the problem we run into is, oh no, we underperformed in a good market, at the end of the day, we're still taking home money on a weekly basis. So you can't get too mad at that. Additionally, I do have a long-term portfolio that I keep on the side where I just buy and hold. So when weeks like this do happen, there's also some added benefit. You may have retirement accounts or something like that where you reap those rewards as well. But the benefit here is, look, we went into the week knowing it was going to be risky with CPI. And we wanted to make sure that if the market went down as it had the previous CPI announcements, I mean, I think it was maybe 7 or 8 in a row, where the market took a pretty significant skid after the announcement. Again, we wanted to make sure that we weren't going to take a dive, right? We're only minus 3.25% on the year. Looking at a $3,400 profit this week, we're only down $5,800 on the year, meaning a couple more weeks just like this, and we're profitable for the year. Right now, that's my number one goal. We pretty much have outperformance wrapped up. If we turn a profit in 2022 in a historically bad market, and in a year where we basically shot ourselves in the foot by digging ourselves a $40,000 hole in the very first month, I'll be thrilled, right? Because if there were some issues there where we took on some large cash secured put positions thinking that they were safe, great lesson. Nothing in the market is safe. But if you look at how we've done since then, since January 23rd, we've taken home a profit of $34,143. And if you look at that, the S&P 500 was at 437 on that date. So going from 437 down to 398, the S&P 500 is still down 11% over that time frame, yet we've taken home, again, $34,143. So all that just to say, we underperformed, but look, this core strategy is working. We want to stick to what we think is working, and we're not going to stray away just because we underperformed in a large week. The biggest takeaway that I could give you guys this week is that the market isn't going to go up 5.89% every single week. And if it does, I mean, my long-term portfolio will make me very rich, but realistically, that's just not going to happen. So we're not going to try to trade it like it's going to happen. Give me 1 second here. All right, so let's talk a little bit about position by position, what exactly happened. And the big thing that kind of crushed us a little bit were some of the downward moves off of the bat, right? If we didn't roll anything, we would have made a little bit more money than this. But of course, it really is important to roll because we always want to protect that downside. It's much easier to take small profits and keep building those one on top of another. It's much easier to do that than it is to have some big, 10% loss in a week and spend the next month trying to dig yourself out of that. So we're okay with that downside. But Carvana is a great example of one, right? If we go to Thinkorswim right here, we pull up the Carvana chart. Let's take a look at it over the past 10 days, right? We remember when it was at 16, they announced earnings. There were bankruptcy fears, yada, yada, yada. And the stock took a pretty significant dive from 13, again, this is $13 a share on November the 4th, down to $6.50 on November the 8th. So within 4 days, this stock went from 13 to 6.5 at the low. And of course, we thought this was way overstated, right? If you go to the 180-day chart, you'll see that RSI was about as low as I've ever seen RSI on a stock. Now it's kind of getting back to the high side, so maybe one that's probably going to cool off a little bit in the near future, but we'll get to that a little bit later in the stream. Point being, we essentially started our position, or had the position going into this week, of 8.5 strike puts, 7.5 strike puts, and then when it dropped further, we added these two 5.5 strike puts. The idea there was that if this expired worthless, we'd get 950, and we could have got 150 from those, and then a combined 550 from those to get $1,650 of profit off of Carvana. However, our hand was forced a little bit, so to speak, when the stock continued to dive, right? And went from 8.91, a position where our 8.5 strike puts would have been a max profit, down to 6.5 on November the 8th. So what we want to think about there, our mindset is that, okay, yes, we could make money if this thing bounces back up, but let's look at the trend over the last 10 days, right? This thing is going to the floor. And in theory, there's nothing stopping a stock from continuing to dive. There have been so many positions where I got too artificially confident because I thought, okay, this is crazy. It can't go any lower. But one thing to keep in the back of your mind is that things can always get worse in the market. So that's what we were worried about, and that's what we want to protect ourselves from, right? And again, our goal on a week-to-week basis is just to make a profit. So what we did was we rolled our 8.5 strike puts. We closed those out for a 950 loss. But then we rolled those down to 6.5 strike puts, right? A level where if the stock held tight right there at 6.5, those would hit max profit. And then even though we locked in a 950 loss, if we bounce back up to the 7.5 level, we'd have this profit, this profit, this profit, and this profit to give us a $300 profit on Carvana. And objectively speaking, when you're looking at a stock that's down 50% in 3 days and you have bullish positions on it, and you could turn a profit if it just kind of hangs steady after that 50% drop, that's a good position to be in, right? Our goal when things move our way, it's very easy. Just take profit, let it expire worthless, no problem. When things move against us, we have to accept that, okay, they moved against us. A lot of the time, even just breaking even is the goal. But if we could actually get a profit like that $300 profit we had set up, that's fantastic. Now, it is a little bit bittersweet that if we never rolled these down, we would be looking at a profit of $1,650. That's a $1,300 difference right there. But at the end of the day, look, this thing got crushed. Insane that it went all the way back up to 1188. But the point being, with our high strike being at 750, all we needed was a bounce back up to here, and we like to play things safe like that. So yes, a little bit of money left on the table by having our hand forced by the bigger dip at the front end of the week, but we still made $300 on the position. There's nothing to be upset about with that one. TQQQ, we took profit early. DraftKings, we took profit early. I think we managed those both very well, especially with the risk that was coming up on Thursday morning. Affirm, this is another great example of how flexible our strategy can be, especially heading into an earnings event. This is one very similar to Carvana, where our hand was forced because of earnings before CPI, right? So if we look at Affirm, you could see exactly when they had earnings, and it's a very similar story to the one we just told about Carvana, right? The stock was at about $15.75 a share. We had these 14.5 strike puts, meaning that we made max profit rather, anywhere above this 14.5 level, which was crushed. But remember, our break-even price if we sell a 14.5 strike put is the strike minus the premium, so about 12.3 or 12.25 was our actual break-even price. So that's going to be down here, which is a pretty significant departure from where that strike price is and a pretty decent-sized cushion. So if we remove this drawing, we'll see that our break-even price was right around $12.25 for the week. However, by the end of the day, Affirm had dropped down below $12 a share, and we knew that we had CPI the next morning, meaning things can get worse. And remember, we always want to keep that lesson in our head that things can always get worse. So we wanted to protect ourselves just in case that happened. And again, we were already dealing with the 25-ish% drop by the end of the day on Wednesday. So the fact that we could have that severe of a drop on a stock that we have a bullish position on again and still be in the game, I think is a phenomenal testament to the flexibility of our strategy. But we did what we're supposed to do. We rolled down, we locked in the loss, we sold the 13 strike put, which gave us a little bit of ability for the stock to bounce right back up for us, which we were happy to take because on a net basis, that would net out to a $300 gain if Affirm finished. And I just realized that I did the math wrong on the stream here. A 14.5 strike put minus $1.22 is a 13.25 break-even price. So when this started to slide below 13, that is the reason why we rolled. I was doing the math here and looking at where these price points were, and I was like, this doesn't make sense. I don't know why I did that. But that makes a lot more sense. This was our break-even price. Wednesday morning, the stock slid below that, so we kind of had our hand forced, right? We rolled down. And we just put ourselves in a position where we could still make profit. So our break-even price goes from $13.25 down to about 12.7. So we moved the red line from here to down to 12.7, step 2. And that's good, right? That's progress. And it doesn't have to be all the way down here, but any little bit that you can move that red line down on a week-to-week basis makes it a safer trade. Yes, we're not going to have that upside if it bounces back to 1450, but again, we just want to stop ourselves from digging these big holes. Our goal isn't to make some huge return in a week. We like to stack steady, consistent profits so we could demonstrate those compounding returns that we talked about at the front end of the stream. But as it continued to slip further, right, as it went below our second break even, and we had this candle down to 12, we said, okay, what are we going to do? We're going to scale further into the position. We always want to start with these 50% size positions so that when things like this happen, because they will happen, we could add that second piece of the trade and further lower our break-even price. So we had a 10 size contract position. We added 10 12 strike puts, and we know that if we double the position size, every cent of credit that we receive on the 12 strike put, is going to be another reduction to our break-even price. So it's 12.7 minus the 42 cents we receive, getting our break-even price down to 12.3 at the end of the day. So while it may not seem significant individually, to go from 13.2 down to 12.7 down to 12.2, but within the course of that Wednesday, we were able to lower our break-even price almost a full dollar, which when a stock's trading for $12 or $13 a share, that's the equivalent of lowering your break-even price by a little under 10%. And that's relatively significant in my opinion. So I was happy to do that, and honestly, it turned out well, right? Yes, there's a little bit of regret because, you look back and, CPI went well, and it went back above 14.5 and finished the week at 17, which is crazy. But again, we want to prevent that big downside risk. And at the end of the day, it's just like Carvana. While, yes, we could have made more, we still walked away with a profit of $720 on Affirm. And again, our original max profit was $12.20, so we only left about $500 of profit on the table here, while still managing our break-even price really effectively. So yes, annoying that Affirm didn't go up after earnings and we had our hand forced a little bit, but great demonstration about when our hand is forced, how we can manage those strikes, how we could strategically scale into positions with both patience and a well-defined plan to start knocking this break-even price further and further down. Because look, can a stock go down forever? In theory, yes, but more realistically, stocks aren't going to go down forever, but we can indefinitely decrease that break-even price that we have. Everything else went pretty smoothly. Unity is another great example of a trade just like Affirm, where it dropped a ton right before they even had earnings, right? We walked into the week, I think this was Monday. The stock was trading at about 26, and before they even announced it was already down to 21. So that's just kind of to paint the picture about how rough of a week that it was for the market before all that started happening. Got a random notification I'll close out of. But that's just kind of to paint the picture for you about how rough of a week it was before CPI. And what's crazy is that you could see the bottom end of this wick right after Unity earnings. It went down to $18.29, and by the end of the week, it was pushing $32, $33 a share. That's almost doubling in a span of 2 days. Omega Vitamin, shout out. Thank you for the follow. But this isn't typical market movement. We don't want to play it as such. So we did similarly to what we did with Affirm. We said, okay, look, it happens. We're not too worried about it. We're just going to close 2 of the positions. I say half. We closed 2 of them. We let 3 ride. So we were in a position where if it got back up to 22 a share, which it did very, very easily, we were still going to make $100. Yes, it's nowhere near the original $550 of profit that we had lined up, but again, we had this thing move against us very, very significantly on the front end of the week. We want to put ourselves in a position where if it continued to move down, as it seemed like it initially would, we wouldn't get slammed. And we accomplished that. So while there was a little bit of money left on the table, right, it's one of those good problems to have because we're still walking away with $100 on the trade. Palantir, Lyft, these are 2 examples of trades we scaled into after poor earnings, but we felt like the valuations were still good. Anytime in the market, and this is definitely a strategy I want to continue to pursue because premiums are very good, and typically your entry point is very, very good as well. But typically when you see a big earnings drop, one of the places I like to look is the news feed for the stock, and you'll see, okay, is this a big earnings drop and banks are issuing sell targets and they think things are still going to drop? If the answer is yes, just leave it alone. But typically if you have an afternoon earnings and a stock tanks, by the time the market opens in the morning, there will be a decent repository in the news feed of new price targets from these banks. And if banks are still issuing price targets, which was the case on Lyft, that are higher than where the stock is, that's typically a good idea to enter in on that because it suggests that, yes, there's a lot of institutional selling going on due to poor earnings, but at the same time, you're getting a good value, and we've already demonstrated with something like Affirm how effectively we could lower our break-even prices. So doing that on a stock that's already at a good value, I think is a fantastic value proposition. But again, just between those 2 trades, quick in, let it expire worthless. That's $420 for us right there with just very, very little effort. Keep your eyes on the market, know what earnings are going on, and that's some very simple profit. Coinbase. This is a great example of an IV reversion type trade. And what I want to point out here is that, IV on coin was spiking. So let's bring up the coin chart. FTX had a bankruptcy. Not was about to say bankruptcy scare, but they actually did declare bankruptcy. So there was a lot of uncertainty surrounding these coin exchanges. Now with Coinbase, this is one that's been on my watch list and a great example of why it's a good idea to have a watch list, right? Because you're familiar with the day-to-day moves in a stock. And we knew that historically, look, where is Coinbase bottoming out over the last 6 months? We see a low at 40.83, we see a bounce at 48, a bounce at 46, around that level. And if we draw the line here to kind of line up with the historical bounces that we've seen on Coinbase, and then we fast forward to what it did this week, guess what? It bounced off that almost same exact level, which is why it's a great idea to have charts that you could save, a good idea to have ideas of levels in your heads where there's previously has been support. So when we saw this big dip in Coinbase, I believe it was on Monday or Tuesday, when we saw it go from 54, down to about 50, we said, okay, we know that 44, 45-ish is probably going to be a decent location. And if we zoom out here a little bit, you'll see that implied volatility was really starting to run up. And we love opportunities like that because it pumps premium into the options. And what goes up must go down with implied volatility, right? Yes, there are times where it could, remain elevated in the short term, but when things like implied volatility go up, they will typically come back down and revert to the mean. And when that implied volatility gets sucked out of a stock, the option premium gets sucked out as well, meaning that the sellers, us, are going to make money on the trade. So let's talk about what we did really quickly there. And with those IV reversion type trades, what you want to do is get in and get out. So we got in on a 42.5 strike put. We got out for 190. Now you might say, HT, this thing never even got below 45. Why did you close out of a 42.5, option? And the answer is that things can always get worse, right? Our max profit on the trade was 270. So we only left about $80 on the table. And while it did bounce, we got out. Guess what? It got worse again. If we go back to the 5-day chart here, we got in, it bounced, and then it got worse again, and we got right back into a similar position, but at a lower strike. And we made 195 from that. So while in our initial position that we had, we could have just let it expire and made 270, by getting out and then re-entering again to an even better position, we actually made a total of $385, which is about 50% greater than what we originally set out to make. So a great example of why when you play these implied volatility reversion type trades, get in, get out, because if you get out, look, you've locked in profit. Worst case scenario, we left $80 on the board. But best case scenario, it goes back down and is in a position where if we kept the original position, we would have been screwed. Now we can get back in and make even more than we originally set out to make. And then that brings us down to SPXU, which was our one. This is honestly what I think was our one mistake this week. SPXU, the 17 strike puts. If you look before CPI was announced on Wednesday, this thing was at about $19 a share. Our max profit was down here, so these really weren't in too much danger. In fact, they were trading for 5 cents a piece on a Wednesday, which is tough. And what I was doing in my head, this is always a great thing to go back and evaluate. Okay, we made a mistake. Why did we make a mistake? How are we going to improve there? In my head, we know that SPXU is a bearish SPX ETF, so it's going to go down if the market goes up. So I knew that I had 16.5 strike puts, and I said to myself, okay, look, if the market goes down to 16.5, hey, I'll be happy because it means that everything else will make money for me, and that's exactly what happened. Everything else did make money for me. However, the issue, of course, is the fact that this started to lose money for me. And let's think about this objectively, which I did a very poor job of this week. If this is trading at 5 cents a piece and we only have 5 contracts, even if it was only trading at 10 cents a piece and we only have 5 contracts, what am I leaving on the board here? It's the difference between making $155 of profit and $205 of profit. And that's what I think is a huge mistake. I got greedy and I held out for $50 more of profit with the justification that, if it comes down here and I lose money on this position, I'll at least be happy because I'll make money on the others. But it ended up closing. We had to close these out for $1.71. So what I could have taken a roughly $200 gain that turned into a $650 loss. And again, if we close this out, our week is now at 2.51% return. We make $4,200. It's much better than the $3,460. And we cost ourselves about $800 with that decision. So I think that was our one big mistake. Even if you've got something hedging, think about the degree to which it's hedging, right? We only stood to make $50 from the hedge. That's nothing in the context of what we were holding in our portfolio. That was a dumb move by me, and that's something I'm going to be more cognizant of moving forward. We can kind of add that to the list of mistakes that we've made lately. But the point that I made in our Discord server this week is that it's always good to have a discussion of mistakes you've made when you've made $3,500 in a week, as opposed to discussing mistakes when you've lost thousands of dollars in a week. So good that we can make mistakes in this strategy, acknowledge those, clean them up going forward, and still have some profit to look back on and build on. SPX, this was one that may look like a mistake because we lost about, let's see, about $1,800. No, that was netted against this. Excuse me, only $1,600. But we lost $1,600 on November the 10th with that one. So that was pretty frustrating. Why did that happen? And the answer is just because we had one of these weeks where the market was just historically moving upwards. And if we pull up SPYX, it's going to load faster than SPX. Same idea here, right? If you look at the 10-day, RSI was insane, and that was what I was going off of. Typically, that's going to work more often than it doesn't. This was an insane move from 375 to 398. It happens, like we talked about, the market's not going to go up 6% a week very often. In fact, I think it's the biggest week that we've seen, or at least Thursday was the biggest day we had seen in the market since 2020. And we know that our SPX strategy is a successful one, right? We're looking at over $10,000 of profit from it. I think over $10,000 of profit from it. So just because something doesn't work one week, you want to take a step back and look and just objectively evaluate, why did this not work? Is it because we did something wrong? Were we impulsive with what we did? How can we improve this going forward? Or was it just bad luck, a one-off event? And if we trade the way that the market is normally going to be, are we going to be okay? And honestly, after looking at that trade, I think it's a lot more of the latter. We've definitely made mistakes with those SPX spreads before, but I don't think this was one. It's just part of the game, right? So we're okay with that. And again, we went right back to it on Friday, and we made $315 back. So right back into it. It worked. Keep the line moving. And that is top to bottom recap of last week for us, where we took home about $3,500 of profit. We're back positive in October we're back positive in November after making money in October. Small drop in September, but since July we've made a little over $30,000. If you go since May, we've made 38. It's been a really good run since January and April for us. And again, those were things that were a little bit outside of our strategy. We got greedy on, but sometimes the best lessons in the market are learned from some of the larger losses, unfortunately. But we've got some lessons in that case, and we've put those to use. And look, since July, we've been crushing it, I think, quite frankly. Like if you look at July 3rd, or right around this window right here, like the S&P 500 has kind of been in this 400-ish range. Even going back to that first week the third week in January, it was at like 437, and it's gone down below 400 since then. That's an over 10% drop, and we've made $34,000 in that period. So again, yes, we've made some mistakes along the way. Yes, we underperformed this week, but in general, the strategy is doing great, and we're just going to keep doing what we're doing. But let's talk about next week. We've got a couple new ideas in play that I want to talk about, and I haven't updated my profit tracker yet, so let's kind of do that live and talk through that together. So we've got a few different trades, and what we did that I thought was a smart thing on Friday was we knew that we were kind of bearish on the market with SPXU, so we went ahead and preemptively opened some positions for next week in the morning. And it worked out nicely for us, right? So if we take a look at what we opened, and I'm doing this off the screen. Actually, let's pull this onto the screen. We could take a look at our trade announcements, and again, if you want to join our Discord server, go to hourglass-trader.com. It's going to be that button right there in the middle, join the Discord chat room. Now, we've got a free section where we're always happy to answer questions from anybody as they come up. More than happy to do that. And we announce one free trade a week. This week's trade made $200. Last week's trade made 50. The week before that made 400. So look, our general goal with all of this and what we do with our streams and our platform is to teach safer option selling strategies to people, as opposed to having you get sucked into these option buying strategies, right? The whole reason we started this was because in 2020, 2021, the market was so crazy. And there were a lot of people who just wanted to get involved in the market. And those time frames were historically easy time frames for people to get involved in the market as Robinhood started to get more popular. More and more people had access to the stock and option markets. But with that, unfortunately, there's some very, very well-intentioned investors who want to learn and want to be successful who get sucked into these traps of people who are like, oh, we took $1,000 and we made $50,000. Come pay me and I'll tell you how to do that. That quite honestly is gambling. It's not going to work. It's the same as someone looking you in the eyes who just want to scratch off and said, hey, I turned $2 into 14 grand. I'll teach you how to do it. It's just dumb luck if it happens, and it's not a consistent, sustainable, and successful investment strategy. And what we've demonstrated here since July of 2020, when we have been sharing these trades publicly, is that what we put forward is a consistent, successful strategy. And that's what we want to teach. And we teach it for free, right? We've got our YouTube channel where we've got videos about our strategies, credit spreads, the HT wheel that we put into play. But the reason I go off on that tangent, and you've got a free trade a week in our Discord server, and we're happy to answer questions. Videos are in the HT videos channel. But the reason I go off on that tangent is because when we look at the actual trade alerts, if you want to be alerted to every single trade we make as we make it during the week, so you can do exactly what we do and get some more stuff like some alerts to IV reversion opportunities like we talked about with Coinbase, get alerted to stock halts, have a feed of market news going so you could be informed on that. That's going to be part of our HT Premium package, what you could sign up for with HT Premium, and no matter what package you pick, it's less than $1 a day. And that is the end of my self-promo, but hourglass-trader.com. But again, going to our trade alerts that we made, here is what we opened for next week. We opened up a few credit spreads because, look, the market keeps running up. It looks very, very overbought right now, so we think things are going to come back down. So instead of just generally playing a bearish XPX credit spread, one thing that I found some success with in the past is just playing down stocks which, maybe don't have a right to be up as much as they are and are a little bit weaker than the overall market, so that when the market goes down a little bit, these stocks will dip more significantly and then you could close out early for a profit. A few of those were Coinbase, which was timed pretty poorly. Carvana, excuse me, not Carvana. I did it on a Unity. There you go, Unity right there. And then I opened some bullish trades on DraftKings, Affirm, and Carvana, which are progressing very, very nicely. So let's quickly put some of those in, right? We've got 10 draft. Oops, let me turn my number pad on so that works. Perfect. Okay, now we're typing. We sold -10 DraftKings, DKNG, 13 strike puts. We did that for 0.34. And again, let's get the formulas in here because we know that this is going to bring us a potential profit of $340 as long as DraftKings finishes above $13 a share. And if you look at DraftKings, it closed at almost $15 a share, which in your head you may say, okay, look, a $1.88 cushion heading into the week, that's pretty solid. But again, look, this thing went from 15, I guess there was a candle, up to 18 on the morning of November the 4th. Down to 10.85, up to 14.76. This is why we're being so cautious, because things are just flying around in the market right now. And going to something like XPX, which is the overall S&P 500, gives you a very good idea of that, especially on a 10-day basis. I don't know if I've ever seen such a big range on this thing, right? If we zoom out to the 180-day, it is flying around right now. And of course, that 180-day RSI, it's right back up in the red. Why do we love RSI so much? Well, let's take a look at the last two times the RSI got up in the red. It was around October 25th to the 28th, and almost immediately after that, it got into the red when it first got to around 3820-ish. Ended up getting to 3900 at the peak, but of course we'll be able to see that when it got there, it took a turn from 3900 down to 3700 and dropped 200 points, which is relatively significant. So when we see that RSI is up here, we definitely want to be cautious that we're going to see potentially a similar drop. And if I had to guess, down to this 3,900-ish level, back to where it began the ascent from the previous highs. So that's our look on the overall market. And that's why we're being a little bit more cautious with the sizing of our trades and the strikes that we're picking out. But another one we had was -5 Affirm. 11, 18 expiry, and those are going to be 14.5 strike puts as well. Not as well, but 14.5 strike puts for a 57-cent credit. And again, that brings in $285. And if we start putting the sum formula here and talk a little bit, I hate that Google auto completes this. This is a massive pain in the ass. Let me just type and select, please. So that's $625 of profit right there. So we're in what seem to be two pretty innocuous positions, pretty low risk, low size. And all of a sudden you've got $625 of profit. Another thing we did was we sold minus 10 Carvana 7.5 strike puts for 23 cents for the upcoming week. Add that to the total, that's another 230 bucks. That puts us to $855 of profit for the coming week. And if we take a look at the Carvana chart, we are a long way away from 750, and I think 750 is a fantastic level to be in at. Now, the one caveat here is it ran up a bunch, so you're not going to be able to get 23 cents of premium like we got, but it's still trading between 10 and 15 cents, as are the 7 strike puts. And again, we like to talk about ROR. We like to target 1% or better. That absolutely fits the bill for that kind of a trade. So good to be in on those. And this is just a great example of how we start to slowly build out that portfolio position after position after position and get a bunch of base hits, which hopefully, for our sake, compound into these really, really nice returns for us. So that's the extent of our bullish positions. We've got a few more bearish ones that we could enter into right here, right? We sold 3 of the Coinbase 50-52 call spreads for 81 cents a piece. At max profit, those are going to be worth 243 bucks. Now, with DraftKings, Affirm, and Carvana, they ran up on Friday, so the opportunity isn't quite as good. But for our bearish positions, if you missed out on the bullish ones, similar story here, right? It ran up to 56, so you have an even better entry on Coinbase than we had. And it looks like it went to 57.46 by the end of the day, but dipped back down after hours, so starting to move back in the direction we want. But break-even price is right around here-ish. And if we remove this line and then zoom back out on a 5-day basis, nothing that I think is out of the question. I think with FTX, a lot of the uncertainty around there, there could definitely be some issues with Coinbase, and that's kind of what we're banking on. But again, the idea here is that we opened a credit spread because we know that Coinbase has the potential to shoot way up, right? If we go on a 20-day basis, this thing was trading at almost $80 a share less than a month ago. So we know that if it does spike back up, it could spike back up big time. But we know that historically, this thing can also have some pretty big dips that we want to potentially take advantage of if there's more uncertainty surrounding the stock. But reason being is, look, the most we can lose on this if we hit max loss is 357 bucks. And that's only if we hold until expiry and it finishes above 52. More realistically, we could probably get out for about 125, 130-ish, in which case it's only a 150 loss for us. So that's something we'll keep in as from a conservative estimate. Actually, let's see what it's actually worth right now. It looks like right now this spread is worth about $1.40. So we'll put that in as the current price of the spread to give a better idea of what our financial position is for the coming week. Another bearish trade that we entered into was -4 of the Unity. And again, these are 11/18 expiry. Everything on here is 11/18 expiry, which is why I kind of get lazy and don't specify. But 32.5 and 35 strike call credit spread for a 51-cent credit. And again, at max profit, this will bring in 204 bucks. And what is this trade? This trade essentially says, look, we saw Unity. We love to use RSI as a measure of if something's overbought or oversold. Look at this thing. This thing is skyrocketing into overbought RSI. And we are going to make money on this trade anywhere below 33. And the reason we chose this level is because previously it looked like it had kind of topped out around this 31 to 32.5 level. And especially when you have that intersection of, okay, we're reaching previous resistance and RSI is, decently overbought, that's a pretty good time to play a stock in the other direction. And again, we did so in such a way where we know that this stock has exploded the last couple days, quite frankly. So if it goes to max loss of 2.5, we lose a bit of cash, but again, we're not going to take that max loss. Maybe 1.75 is a little more realistic. And yes, we can lose a little bit more cash on that. But as things currently stand, we sold a 32.5 strike put. It's right around that level, meaning if it just stays flat or goes down this week, that's max profit of 204 bucks for us. So again, these are all building on each other. If the market turns around and this gets max profit, all of a sudden we're above that 1,000 mark. And, yes, we made $3,500 last week, but look, this is like 5 positions when typically on a weekly basis, we get ourselves up to about, what's the count here, 27. And that's not abnormal. That's about how big our portfolio looks every week. So there's a lot that we want to add to this. And that's what we'll talk about quickly after we lay these out. The other thing that we have here is an SPX Condor. Now we have this SPX Condor idea and it's been working very, very well for us. In fact, we've ran it. Where'd it go? We ran it 6 different times, and it's won 6 times, lost 0 times for profit of $2,770. Now, the issue we run into is one of the things we pride our trading strategy on is it being very, very hands off. So you don't necessarily have to be, plugged into what you're doing all the time. You could go put your trades in on a Friday or a Monday, let them run the course of the week, and then manage them on Friday, or just set alerts where if it dips below X price, I'll tell my phone to give me an alert and I'll jump in on something. That's what we love about our strategy. I personally have a pretty demanding full-time job, so I can't always be plugged into what's going on. I think I do a decent job, and I love the whole work from home strategy because you can kind of keep an eye on things without really getting distracted. But that's what we love about our strategy. Now, there's some things we like to do on the side which we think are very profitable, but require a little bit more of an active trading commitment. The SPX condors are a great idea, or a great example of that. And we've ran them between October the 4th and October the 11th, 6-0, almost $3,000 of profit. And again, you don't need a ton of money to execute these, right? The way we looked at this was if we had a hypothetical account balance of $5,000, and just within that 10, 9, 8-day period, we essentially made what was a 55.4% return. And the reason that we consider these such low commitment is that kind of max loss, so to speak, is $1,200 per cycle. And there's only a 14.82% chance that happens per cycle. So if you do this 200 times, it's going to happen roughly 30 times to you. You'll lose 36K based off of those. However, you'll make more. The expected value is positive. I love the way the math stacks up. However, the issue we've had lately is I personally have not been able to keep as close of an eye on these. So I haven't been able to run it because we want full transparency in the trades that we enter into. I want to alert my trades to you guys and keep you guys, abreast of what's going on. I just haven't been able to do that with these spreads lately. So I've come up with a little bit of a compromise. And it uses the same idea as this, but instead of a 0-day iron condor, we're using a 5 to 7 day to expiry. And we set this up on Friday. And let's just put this into our tracker and talk about what it was. Because I'm kind of excited about this idea because I think it's going to be a great way, especially for those of you who do prescribe to that less active trading style. You could still take advantage of the math behind this idea while fitting it into your less active trading approach. So typically with these SPX condors, if we look at these, we sell 3 at a time. And if a side gets breached, we double down and we add one to get to 7, and then we hedge again with 3 more on the top side. If you don't really understand what we're talking about, hourglass-trader.com. I think if you go to our blog, we should have an article on here. Maybe we don't. If you go to our Discord server, I take that back. I still am yet to publish the SPX strategy article. But if you go to our Discord server, and I believe it should be in the pinned messages here. I'm going to find it. I think it's in the spreads channel. Go to the pinned messages, and there you go. We walk through the math of this iron condor strategy. We talk about how it works, and why the math works in our direction. So that is what we've got, and if you want to read through that, pop into the spreads channel, and that's what I'm talking through right now. But, and again, if you want to join, hourglass-trader.com, join the Discord chat room, it's all right there. But with that said, we don't have time right now, personally, because work's getting a little busy, to do these on a 0-day basis and be looking at it every minute, and keep our eye on it and manage it that actively. So the trade-off here, and again, already talking over myself. We'll want to remember that our profit levels or our profit outcomes here were 600, 760, -80, and -1200. And that's over the course of 5 days. So if you did these 5 times, theoretically you could lose 5 times and lose $6,000. It's very, very unlikely based off the probabilities that we've calculated, but it could happen. So that's what we want to keep in mind. So the alternative that I'm proposing, and I don't know if I want to do 12 or 11 here, but is to start with a week-long one, so you have these longer windows of entry and exit, and you have a much wider cushion. So if the market trades relatively flat on a 1-week basis, you're going to be looking at a really, really nice boom, boom, you'll hit max profit. Result 1, instead of $600, is going to be $1,000. Now, if one of those gets breached and we close for what, I think 2.8 or 2.75 was the assumption. We'll do that one right here. 2.75, you close, you let this one ride, and then what do? You roll the losing leg down, you double it, and you add one. So if this expires worthless, that's going to be $1,100 of profit. And then you hedge again on the opposite side with 5 contracts, meaning that your new result 2 is 760. Question from Johnny Felix: did we make a video on how to make the profit tracker? And the answer is yes, we did. So if you go to our channel right here, that's going to be the YouTube studio actually. If you go to our YouTube channel, you'll see that there is a video on how to make the profit tracker. And I think more specifically, if you pop into the Discord server and go to the actual channel where we share our profit tracker, we have the video right here. So that's a quick, easy way to find how to make your very own. But back to these, right? The idea is option 2 right here, where if both of these win after the roll, you're going to make $760 with our 0 day, but with our 5 day, you'll make $1,225. Now let's talk about the downside. If one of your hedges loses, you are going to lose, 275 is the hypothetical close. You're going to lose 150. So it's not quite the $80 loss, but it's very, very manageable to lose $150 on an SPX strategy over the course of a week. But if this one wins and this one loses, which is our oh no, we lose scenario, instead of losing, let me think through this here. Yeah, instead of losing $1,200, we've lost $1,800. So it's a 50% larger loss, roughly. Not roughly, exactly. It's a 50% larger loss in that doomsday scenario, so to speak. But look, result 1 is roughly a 66% greater profit. Result 2, if we have to close out of this, and then we hit 2 winners right here, is, let me think, 500 greater than that. It's about 66% greater profit there as well. This is twice as large of a loss, but on a dollar basis, it's very, very insignificant. And then this is only a 50% greater loss. So I almost like the way that this math works out better than what we had previously. And when you add that to the fact that we now have 1 week to manage these things, I think that's a fantastic value proposition. So with that said, you may say, okay, well, if I were going to run a 0 day spread and get 600 for 5 days in a row, that's $3,000 of profit. That's nothing compared to the $1,000 of profit you get right here. And I say, okay, well, if you ran this 5 days in a row and hit some of these losses, you potentially could get to a $4,000 loss, which is much greater than the $1,800 loss we hypothesized up here. And if you want to increase those numbers, you absolutely can, and just multiply these by like 2 or multiply them by 3 if you want to get larger positions and change the dollar value, right? The probabilities aren't going to change based on how large your positions are. Just keep the general idea of an iron condor. If it gets breached, roll down, add 1, and then hedge on the opposite side. And with that said, one other great thing that I want to talk about here is that on the 0 day, there's a lot of volatility on a 0 day basis. All right, and I think we actually got in and out of a 0 day spread before I realized that I was getting dragged into a work call on Friday, and we got like $20 of profit. I didn't even bother putting it on the profit tracker. But what can happen with these cushions you set up with 0 day volatility, and let's just pull up SPX on Friday to demonstrate this, you potentially could have one side breached, get chased out, and then both sides, that could happen. Because we only hypothesize that like one side gets breached with the assumption that, if it gets so low that this happens, your original one's not going to get breached. Technically, that could happen. But now let's talk about what we've got set up for SPX this week, right? We now have this condor with a 38.90 short leg and a 40.90 short leg. The great part about this is I think that takes that risk off of the table, right? Because if SPX gets down to 38.90 this week, I don't think it's getting back up to 40.90. We're on a 0 day basis. That's much more likely of an outcome. So let's go to the 5 day here. I kind of want to take all these. Let's just remove all these drawings. It's a lot of them, but they're now gone. My chart on SPX has been saved. But again, we're now at 40.90. And then on the downside, I believe we are at 38.90 on the short leg. So we have this really, really wide range, and it may not look that wide on a 5 day basis because, again, Thursday was the biggest day in the market since 2020. So it might be a little more useful if we look at it. I just completely missed every button I tried to hit right there. Bear with me here. Okay, let's close out of here. Let's try this again. Normal drag, we're back. So it looks much better when you zoom in on like a 2 day basis. And again, on Thursday and Friday, the market still ran a very decent bit. This is a 100-point move in SPX, where if you look at like maybe a 20 day basis, it's a little bit more of a, sine wave type pattern. But the idea here is, look, if it gets down here, it's not coming all the way back here, and you get decent cushion on both sides of this trade right here. So I really am optimistic about the idea of these. And if we go back and put these in our weekly tracker, getting back to the original exercise that we were going through, we have -5 and -5 SPX call spreads where we've got 40.90 and 40.95C for $1. And then we've got 38.85 and 38.90P also for $1. And again, if that hits max profit, all of a sudden, we're now up to $1,800 of profit. And if this comes back down, all of a sudden we're up to $2,300 of profit. And this is with so few positions. This is with 7 positions. We're typically up over 20 in a week. So there's a lot that we can add to this. Now, it's tough to talk about what we want to add because the market, again, is overbought and we love to open bullish positions. We already have a couple bearish positions. And if the market opens green on Monday, I may look to add one more. We love to go to this scan of high ROR puts. This is kind of our bread and butter, right? If we run this scan, this gives us objectively highest option premiums in the market, which we can then sell to make some decent money. But if this loads, we look at these. Look, a lot of these, this is like a leveraged, cold and boiler, like leveraged energy, gas, ETFs. Yin is a Chinese company. SI, what's going on with SI? Let's take a peek. Type that in, Silvergate Capital. I believe this is a crypto-related stock. It went from 26 to 41 after hours. That's kind of a crazy move right there. We're going to leave that one alone. Unless we can go way out of the money. But 17.5, you could go down there. You could go down to 17.5. This is stupid. Let me look at the 180 day. You could go down to this level here and make $250 if you saw that. However, I'm certain there's something weird going on with this stock. They say they have no outstanding investments in FTX. I'm not going to get into like, oh, we're good here. No, nothing to worry about. That's just kind of an area I want to stay away from. UBX, this is maybe an interesting one. I've never heard of this stock. Unity, it's biotech, so I imagine they potentially have some sort of event coming up. And also, there's a pretty wide bid-ask spread, so I don't think these are actually trading for 25 cents a piece. So kind of a false alarm right there. Carvana, there we go. We love Carvana. Newegg, a 2-strike put. The last time we looked at Newegg, it was trading at 4 a piece. Crazy to see it all the way down back at 2. But let's see, the bottom's at 150. If we sold a 2-strike put for the coming week, that'd get us about 15, 16, 17 cents a premium to get us down to this 185-ish level. For me, that's just not really close enough to where we want to be with a very, very recent bottom at $1.50. But maybe want to keep an eye on just kind of as a low-risk flyer to add $150 of profit. Maybe not the worst idea in the world on that one there. AMC is definitely on this list, but I'm going to try to stay away from those unless the market gets really smacked down. Those are a decent kind of safe haven to look at. Affirm, we're already in on Affirm. Upstart is basically the same thing as Affirm, so you're not really getting a lot of diversity there. MSOS comes up on the list, and that one's been a very good moneymaker for us this year. We could go down to about 10.5 and get a 20-cent credit, which would get us down to a 10.30 break even. I don't hate the idea of that 10.30 break even on MSOS. So if we go here, we can maybe add to our little watch list right here. MSOS 10.5p. I know Barkafan and myself tried to get a fill on a 10-strike put, but didn't quite get that to hit on Friday. But again, nothing wrong with going 50 cents higher on that strike. Unity, we definitely know about Unity. And one thing that I thought of, since we have a 32-35 strike call credit spread, is to maybe hedge that by selling cash secured puts, because we like Unity as a stock. We liked it in this high 20s range, and it's right back up there, but scares the shit out of me that it was just recently under 20 after they announced those earnings. Makes it seem like this is one of those artificial spikes, a lot of short covering here. So the question for me was basically, how low can we go and still get a decent credit here? I'd like to have a half-size position for 2%. And we potentially could set that up, to be honest with you, at the, at that 30-35 strike. So if we sell maybe 5 of these at a 30.5 strike, we'd be looking at about $300 in profit and set ourselves up with this really nice profit window between 30 and 32.5, where we would make like $600 on Unity. I mean, let's talk through this and look at how this looks. If we sold -5 excuse me, -5 Unity. Let's be a little more conservative here with a 30 strike put. And those are going for what, 55-ish cents. What we're looking at there is about $275 in profit. But the good news here is that if we kind of hold through, and this does end up at like 33 and this is worth a buck, it kind of hedges that loss on the upside. But the other issue here is that if Unity goes down to like 29 or something, this is going to be worth a buck. We're going to lose 225 there. We'll hit max profit here, and it comes out to like 40. We end up giving ourselves like a window between 29 and 33, if we want to look at that. Let's remove these drawings here. Those are points of resistance that I previously had. But the issue is we kind of give ourselves this window between like 33 and a half and then like 29 where we profit. But based off of the, even just the 5-day movement, if we pull this back up, it doesn't seem like that's a great that doesn't seem like a great profit window to be in. I think with Unity we pick one way or the other. We lean on our favorite technical analysis metric, which is RSI, telling us it's going to be going the other way. It's running back into where it's previously traded. I think there should be some sort of resistance here. I think we stay bearish. If we finally get that red day and it pops back down to the 30-ish level, then we look to enter around 29, 28, and I think that's the game plan right there. But for now, you could try to hedge that out with like a cash secured put, but I don't love the idea of doing that. So staying away from that one there. And again, what we like to do is enter into these things when they're oversold. That way, when the bounce comes, well, we are reaping the rewards there. So we like to intersect this with HT oversold stocks. So instead of having this list of 1,200 options where there's decent option premium, we could really cut this list down to options where the stock has been sold off recently. And when the market's up 6% in a week, it's going to be a very lonely list. But we've got 3 stocks here. We already looked at SI. Crypto Risk, I don't know if that's necessarily a place that I want to have my hand right now. Lite, Lite, could not tell you what this thing is, but Lumentum Holdings, looks like they had a tough earnings. Bounced off that 55 level. Do we have live news with profit targets? Downgraded to neutral. We've got an $80 profit target, and again, earnings were, it looks like the 8th, so anything we see here, 72, 85, 80. I mean, they don't look horrible. It looks like they're making money, they're profitable, positive EPS, that's always a good thing. If we go to Lite, we go to Market Watch here. Let's type in Lite, it's going to pull up the PE ratio for us. And the PE ratio is 45.07. Which is a little tough to stomach. And why is that? We love the idea of PE ratios because if you look at the S&P 500 average PE ratio, let's go down to, this is the website I use. This is the website I use. As of right now, just the average PE ratio in the market is 20.77%. Throughout the course of history, which I mean, it takes into like pre-1900 into account, the average is 15.98. But looking more recently, 20 is not a horrible place to be. Anything in the 15 to 20 ratio, I think, is more than reasonable. However, the issue here, right, is that Lite has a price earnings ratio of 45, which other than Pinterest is about as large as it gets. Now, there are a couple reasons why you could still be comfortable with an investment that has a really high PE ratio. The first of which is the idea that if a company has just achieved profitability, their earnings are going to be pretty low, but the trajectory that they're on means that their PE ratio, as the growth continues and earnings get higher and higher and higher, the PE ratio is going to go down. It's the same idea behind, like, if you've got like $1 billion, this is like maybe a little bit hyperbolic of an example here, but if you have like $1 billion company who just achieved profitability and made $1, and then the next quarter makes like $1,000, that would be like, oh, we had a 1,000% increase in our or a 1000x increase in our income, which is like, yes, technically you did, but that's a little bit misleading and not necessarily interpreting those numbers correctly. So if you have a company that's just gotten to profitability, that's one reason that they potentially could have some elevated PE ratios. And another reason, for an example of a company that's been profitable for a while but may surprise you when you see the PE ratio, is Amazon. Amazon has a PE ratio of 83.63. Which is really, really large. And the question is, look, Amazon's a good company. Seems like it's had a good value. In fact, if you look at Amazon, yeah, they have an 83 PE right now, but I mean, what the hell was that PE ratio if you look a year into the past when they were trading at like 200 a share? And the answer is, yeah, their PE ratio is above 100 historically. But the reason for that is because let's think about the income statement, right? Amazon is a growing business. So they're putting all of these expenditures into things to grow the business. So that's going to knock down earnings a little bit. And that's just to keep achieving forward growth that they've had. So if we go look at their income statement, and this is what we're about to do with Light, SEC Edgar is the Google search. Click on company filings. I think this is going to take me where we want. There we go. We go to AMZN, which is Amazon. We're going to click on that. We're going to go to their 10Q, which is the most recent quarterly report. Title page right here, nice and easy. You want the consolidated statement of operations. And there you have it, right? You've got their quarterly income statement, which walks from revenue, cost of goods sold, operating expenses, other income and expenses, and gets you down to net income, which we have right here. And in the most recent quarter, 2,872. And of course, these are in millions, meaning that they had 2.8 billion in net income. Now, that was done off of 128 billion in net sales. So cost of sales numbers here are a little bit larger. Their gross margins aren't incredible. But operating income here is where you see some larger numbers. You see some other expenses or other income right here. You see negative interest expense, which is income. Honestly, they're not looking too bad in that regard. But the idea here is there's a lot of expenses baked into here that Amazon has in order to grow the company, which are artificially knocking down earnings. So that's why people are generally okay with the Amazon PE ratio. So it's important to kind of look a little bit further into those financial statements, really see what's going on with those. But with that said, we've got a company that's oversold a little bit. If we go back to that Light chart, Lumentum Holdings, and again, the first thing we want to do here is figure out what the hell this company is, right? San Jose, California. So the concern number one that this is some random like Chinese stock. We're good there. They're a provider of optical and photonic products. They're in the information technology. Looks like they make lasers. They peaked at 105. Back in January 17, they're at 37.95. So, I mean, doesn't look horrible. If we go to analyze and we go, I think we can scroll down here and actually see historical earnings. Earnings per share looks like it's trending in the right direction, right? 2021 was 507, but I believe we saw from their news report that it was just $1 or something. And again, that's quarterly. So we're not too worried about that. They lowered guidance a bit. But again, quarterly EPS of like $1.30 gives you annual EPS of like 5.20. So that's still relatively in line and a little bit higher than what they had before. Let's see if they've got PE ratio down here. Their 5-year average is 32.56, so a little bit elevated above what they've got. And again, this is a great example of how you can use this Analyze tab to quickly get into some of these numbers as opposed to just digging into the financial statements. None of these look terrible. Trending in the right direction in EPS, book value per share going up. We like book value because that's representing intrinsic value in the shares. You'll see a lot of companies with negative book value, which is, head for the hills on that, but you see a nice trend in book value per share. This honestly doesn't look too terrible to me. Let's get back to the 3 years to make sure they haven't come from anywhere crazy, and I really like this as an entry point for Light. So let's quickly take a look at the financials to make sure there's nothing crazy. And look, once you start reading through these financials, it's kind of a fun exercise. I do this. This is a big part of my work, so I'm very familiar with these, and maybe less fun for me because I have to do it a lot. But if you're interested in a company and want to learn a little bit more about them, there's a lot of good stuff in here, right? Even just outside of the income statements and the balance sheets and the statements of cash flows, you could look about the management discussion and analysis is a really, really interesting section. They talk about their company. You could learn a lot about what's been going on. Looks like they had a merger back in August of 22. They talk about COVID impact to the business, right? This is a big thing, especially in my line of work, because I do financial diligence on companies that private equity firms are looking to acquire. COVID-19 impact is huge, right? Because if you want to look at historical earnings and you know that there's this big event in 2020 that may have caused this huge dip in earnings, you maybe throw that out when you're looking at historical trends to kind of normalize what earnings would actually be. They talk about supply chain constraints, but like the management discussion and analysis, the MD&A section of the income statement or the financials is a really, really great place to learn more about a company, see what's going on. They've got segment breakdowns. They talk a little bit more specifically about some of the broader level items that you'll see on the general income statement. But, I digress. Back to the reason we're here, which is for the income statement of operations. And it looks like on a quarterly basis, let's see what happened here. What happened here? Their gross profit is down, but revenue is up. And it looks like net revenue has jumped 50 million, whereas cost of sales has jumped 80 million, which is interesting. They've amortized some intangibles, which this isn't a real loss, right? If you acquire something like a company and there's this idea of goodwill, what is goodwill? Let's say that you're buying a company for $100 million, but you look at all of the value of their assets and it only comes out to like a net $80 million. And you want to bring those onto your books at $80 million because you're supposed to bring them on at their value. What do you do with this $20 million gap? So from an accounting perspective, this $20 million goes to something called goodwill, which is you think this company is worth so much that the goodwill of the company caused you to buy $80 million worth of something for $100 million. And this goes on the balance sheet and it's amortized over X amount of years. I forgot off the top of my head, that's not good, but it's a long time. But point being, when that's amortized, it hits the income statement as amortization expense. So when you hear this idea of companies reporting EBITDA, which is earnings before interest, taxes, depreciation, and amortization, that EBITDA number strips that out because it's not representative of actual operations of the company. So this 23 million right here, I'm not concerned about this when we're looking at gross profit. The fact that it increased, not a big deal, but makes sense, right? Because when we were looking at the MD&A section of their financials, they just acquired somebody in August. So you're going to have a little bit more amortization of, I'm assuming this is goodwill based off of that acquisition. But moving down here into your OPEX, research and development, SG&A, these are very typical buckets. Typically sales and marketing for these types of companies is also another bucket. But it looks like general and admin expenses, which I guess is merged with selling and marketing, has jumped very, very significantly quarter over quarter. Why that is, you can't tell from here. MD&A is a great section to read. I'm sure there's a little bit of discussion on that. But, point being, that is what drove down where's net income? Their net income period over period, right? They went from 81.5 million of net income to a loss. And I don't want to bore you guys to tears by sitting here and reading through these financial statements and trying to figure out, if there were any external factors during Q3 that caused this kind of a loss. But the idea is you look at this and say, okay, I've identified one, two, three areas that are a little bit different quarter over quarter, which is why the stock dropped. Can I read through these financials and get comfortable with what was going on? And, we can maybe quickly do the exercise if it's not going to bore you guys to tears too much. But we go to MD&A again. This is just a disclaimer about forward-looking statements. This talks about their company. This is an M&A. Let's keep looking right here. What do we have? COVID impact. That's not going to be what we wanted. Note 4, they talk about business combinations. Let's go down to note 4 really quickly. Here we go, right? So when we have, this is actually a phenomenal example of how you can dig further into these, right? Because we remember when we looked at the income statement, let's go to the statement of operations really quickly. We have these buckets of operating expense, right? Research and development, selling general and administrative, restructuring and related charges. And restructuring, that's something that screams one time to me. So similarly to how this isn't really representative of their operations and their business, this probably isn't either. So that's 30 million worth, but we still have, $50 million gap to bridge between the previous year's Q3 and what we've got here. We've identified that R&D and SG&A are big increases on the expense side. So let's go down here and go to where they discuss those specifically. Did I scroll past it? Was I flying down here? I don't think so. No, let's keep going. Where did they talk about? We've got net revenue here. Let's see. There we go. Gross margin, whatever. I mean, it's important, but not what we're looking for right at this second. So here we go. This is a very typical, like, this is almost word for word what these things look like. And like when I write my reports, like this is what these look like as well. But R&D expense increased by 34.4% compared to the prior year. Again, this is exactly what we were looking at and identified above. The increase was primarily driven by an increase in payroll, stock-based compensation, interesting, and other compensation-related expenses. Now, an increase in payroll makes sense, right? There's rising payroll costs. Now, what we want to get comfortable with is how much of the increase is driven by payroll, which is something that's going to be an ongoing operation of the business, and how much of the increase is driven by stock-based compensation, which is not really a cash-based expense. That's not typical, operations of the business. This is all, again, this is related due to the additional headcount from the merger with NeoPhotonics and the acquisition of their telecom transmission product lines, which payroll, that would make sense. But compensation via stock and other are typically kind of one-time things in order to keep people on. A lot of the times when you see these mergers and acquisitions, the company that's acquiring is going to say, okay, we know that people may just take these acquisition bonuses and leave. But what they try to do is increase compensation for the acquired company. They try to offer stock in the company. Those are all incentives for the employees of the newly acquired company to stay on board so things can continue as normal. It is a little strange they don't break this out here, but it is only a quarterly financial, so keeping that idea in the back of our head. But SG&A expenses, this was the biggest increase we saw, right? We saw a 42.4 million increase from Q3 21 compared to Q3 22, primarily driven by an increase in payroll. Again, makes sense, payroll for selling employees, and employee compensation related to the additional headcount, blah, 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 blah. Certain equity awards, look at this, right? Exactly what we just talked about. When they acquired NeoPhotonics, how do you keep those people on board? You give them incentives to stay, and that's exactly what they talk about right here. Certain equity awards for NeoPhotonics employees were accelerated, and that's what you do. Total stock-based comp associated with the acceleration was 11.9 million, right? So we've got an $80 million gap in net income. Remember, we saw about 30 million or like 20-ish million of restructuring. No, excuse me. What was it? This is page 45. I'll come right back here, I promise. There it is, right? We saw about 23 in amortization. We don't care about that. We saw 10 in restructuring, so that gets us to about 30. And if we go back down here to page 42, where we just were, come back to me, we are going to see that there is another. Where did it go? How did we just lose it again? We weren't on 42, were we? I totally missed that somehow. But we're going to see there's 11.9 right here. So of that $80 gap, we've got about 40 million of it bridged. In addition, they incurred 16.2 million merger and acquisition related costs, which gets you to about $56 million of the difference accounted for. 3.8 million of amortization. We've already basically kind of mentally removed that. So there's kind of a $30 million gap here still. We talk about restructuring. We're going to ignore that for purposes of this. That's factored into our gap calculation. And again, that 9.3 million, why do we ignore that? It's because it's attributable to severance and things related to the acquisition, right? They're not going to be acquiring companies every single month. So you don't really want to factor that into the general operations of the company. But with that said, liquidity looks okay. Cash and cash equivalents, it looks like they're decreasing quarter over quarter pretty significantly. And I won't bore you guys to death too much, but point being is you see these big dips, and it looks like we can account for a lot of the dip, right? We've accounted for about 55 million of the dip, and I'm comfortable with that. Quarter over quarter, would you typically want to see growth? Yes, we do, and we see that a little bit in top line. We see that in top line as net revenue has grown about, not significantly, maybe like 10-ish%. But that's definitely still there. And, the flip side of that is, yes, the company definitely has deteriorated year over year, but it looks like their financial position is still okay. And that deterioration has been reflected in that decrease from 110 down to 57. Now we know that their earnings, their PE ratio is a lot lower or a lot higher than we typically would like. And I think that's factored in big part by this acquisition that we see right here. Artificially decreasing earnings for the time being. So I think a great example of a stock where the PE ratio being in the 40s isn't necessarily representative of their true earnings and true, valuation, because there are these one-time things that are going on. So I think I'm comfortable with light at the 50-ish level here. We see that it's bottomed out at 55.18. We don't really have any bottoms below that in the last 3 years. This thing has weekly options, which is great. There's some whatchamacallit, volume. Looks like bid-ask spreads are pretty wide, but I think the idea here, right, maybe start with one contract, try to get it sold for $1. That's going to be about a 2% ROR. If we sell a 56 strike put for $1, that gives us a $55 starting price, which is lower than it's been in the last 3 years. Based off what I've read in the financials, I don't think this company is going to explode in the near term, as in downwards. So that's something we're comfortable with jumping on. And again, at the money every single week, it looks like you can get a little over $1. So just keep whittling that price down. And I think I'm happy with where this one is. So I like the idea of, look, while it was a little bit quick, maybe a little bit more surface level, we've done our diligence on LITE. We like the idea of it being in the mid 50s, and I think that's a fair price for it to be trading at. 56 seems like a great price to get in on, and that's something I'd be happy to potentially add on Monday morning. So we'll go LITE 56 strike put for $1 to get us. Oops, I completely whiffed on that. 56 strike put to get us to $1. So thank you for those of you who bared with me during that. Fred Step, appreciate that. Glad you enjoyed it. Sunday morning stream, we don't have as many viewers on, so for the 6 of you that are on, hopefully you enjoyed that. But long story short, if Google Finance weren't completely messing up, pulling in these prices, we would see, there we go, just got to refresh the page, I guess, that last week we took home a profit of $3,400. We have a much lower amount, I guess much smaller amount of positions in our portfolio, meaning lower risk. And why do we want that? Big picture takeaways from the stream here. It's because SPX is a little bit overbought here, right? We go on a 180-day basis, which is our favorite fridge opener. What's going on, man? Glad you can be here. But we see SPX on a 180-day basis is in the red. When things are in the red, we want to, hands off. If they keep running for a little bit, they keep running for a little bit. But historically, what do we see when something gets into the red? We see these sustained decreases, gets into the red. And if it's not a decrease, it at least flattens out for a little bit. So we want to have some bullish positions, which we do, but historically we see it get into the red, comes back down, get into the red, dips again. So hands off, wait till 180-day RSI gets back to a little bit more neutral of a position, and then we could really start deploying more and more capital. But lower risk here. We've got some bearish positions to counter that, and I really want to just take things a little easier this week until the market cools off a little bit. Thursday, biggest week in the market since 2020. That's why we're not going in with a ton. It's fun to go into weeks saying, oh, if nothing happens, we've got all of our trades locked in. We're all set up. We're good, and we're going to make $2,500 to $3,000 a week if nothing moves. I love doing that. It's much easier. But sometimes like this is when we have to be traders a little more and try to time our entries a little better using tools like RSI. So we've done that. We've taken a look at the market. Could an SPX 4100 test be incoming? Question from Otto Beat in the Twitch chat. Very possible, right? If we zoom in a little bit further here, 4100's right here, and I already got the line there. And it looks like that's kind of where we initially gapped down back in mid-September before it came back down. And I don't know if there's a ton of resistance, to be honest with you. I don't see a ton of resistance between 4,000 and 4,100. The only thing that could potentially stand in the way there is the fact that 4,000 is this big psychological number. So that could potentially knock it down in the short term. I think what I could realistically see happening is it coming down to like the mid 3,900s. RSI gets back where we're comfortable with it. We start throwing cash in. If it falls back down to this 3,800 level, no worries. We'll still have cash to spend. But if it runs up, we'll at least have the opportunity to add a little bit more. With these credit spreads, keep an eye on those during the week. Coin's moved against us. Unity's moved against us. But they're both, I think, decently manageable. If we get a dip on Coin, get in, get out, right? We want to lock in profits on these because the last thing we want to do is like hold a profitable call credit spread overnight and then have it move against us, overnight on Friday and have a winning position turn into a losing position. With cash secured puts, it's okay to hold those overnight because you could take assignment. You can't really take assignment on credit spreads, so those trades need to be managed differently. But we've done a little bit of research. We like MSOS at a 10.5 strike, at least for now, and we went into a deep dive on the light financial statements and talked a little bit about how we're comfortable with that and why PE ratios may not always be what they seem. So we're comfortable with throwing our hat in the ring for a 56 strike put on that one, with the understanding that we have the capacity to double down and sell one more. But with the way the option premium looks on that one, the price point, I think it's a great entry for us right now. And of course, the stocks we typically have on our watch list, those are going to stay on our watch list. And when the market's red, and I guarantee you, the way things have been lately, you won't have to wait long to see another red day. Sometimes the market could go on such a nice run that you're convinced that, I'm going to miss out if I don't jump in. We're never going to be red again. I can assure you there will be another red day. There will always be a day where you're like, oh, shoot, I wish that I had waited. And it's better to underperform and still take money home when the market's just completely ripping upwards like this, than it is to be, sitting there holding some bags, being full of regret and losing money because you got a little bit too greedy when things were running too hot. So again, 5 days in the market is a long time. We're wrapping the stream up right now, full screen camera again, but 5 days in the market is a long time. A year is even longer, and on a yearly basis, I think we're doing great. We're down about 3%. S&P 500 is down a little under 20%, and NASDAQ is still down around 30% on the year to date. So we're doing great from an outperformance perspective. Yes, it's a little annoying that last week we underperformed slightly, but it's nice to be annoyed with $3,500 of profit. And I think the kind of patience we exercised last week is the same kind of patience that we're going to want to exercise this week as well. We've got a few positions heading into the week, a few bearish positions. Keep an eye on the SPX 180-day RSI. That's going to be our biggest, indicator as to when it's going to be smart to get back into the market. But that's all we've got for this week's stream. Thank you guys who joined us at the early Sunday morning streaming time, because I'm a little bit busier tonight. We couldn't go off at a normal time. But until next time, this has been the Hourglass Trader, where as time passes, we make money. We'll talk to you guys again next week, hopefully with more money in our accounts than we have right now. So thanks to all who tuned in, and we'll see you guys again next week or at some point this week in the Discord server, hourglass-trader.com, if you want to join in there and trade with us during the week. But thanks so much, and we will see you guys again live next week.